Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Weimob Inc. Annual Report. Weimob Inc., a leading investment holding company in China, offers a diverse range of digital commerce and media services to its clients. Through its subscription solutions segment, Weimob provides cloud-hosted commerce and marketing software as a service products, customized software, and other related services such as ERP solutions like Weimob, Smart Retail, and Heading ERP. The company's merchant solutions segment caters to the online digital commerce, marketing, and financing needs of merchants. This includes assisting merchants in purchasing online advertising traffic on various media platforms, providing online marketing support services, and offering in-depth operation and marketing services. By offering these comprehensive solutions, Weimob Inc. has established itself as a one-stop shop for businesses looking to navigate the complexities of digital commerce in China. Weimob's extensive range of services includes software development, customization, and integration with its own platform, WOS. The company's expertise spans various industries, from retail and hospitality to finance and e-commerce. With its headquarters in Shanghai, Weimob Inc. has established itself as a major player in the Chinese digital commerce market, providing innovative solutions to businesses of all sizes. Weimob Inc. maintains a market capitalization of $7 billion, broadly in line with the industry peer group. Weimob Inc. trades at a higher price-to-book ratio of 2.83 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The leverage on the balance sheet appears elevated, with liabilities of 74% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has weakened over the past 5 years, accompanied by declining or negative operating income. This suggests the business may be eroding shareholder value and warrants caution. The share count has increased, while revenue and shareholder equity are declining. This indicates that management has not yet proven the business model is sustainable. This also raised the question if that management is diluting shareholders to sustain the business. The share count has increased, while revenue and shareholder equity are declining. This indicates that management has not yet proven the business model is sustainable. This makes the investment case highly unfavorable. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline can be identified from the recent financial performance of a company. On the positive side, AI-related revenue has seen a significant increase of plus 237.5% quarter-over-quarter in the second half of 2025, contributing to overall revenue growth. Additionally, merchant solutions revenue has experienced a substantial year-on-year increase of 65.1%, driven by higher rebate rates and net rebate revenue. The company's gross profit margin has also improved significantly, rising from 63.1% to 90.9%. This improvement is attributed to the establishment of its AI plus SaaS presence through Weimob WAI, a large model application product. Furthermore, fair value changes and impairment losses related to long-term equity investments have contributed positively to gross profit. On the other hand, revenue decline has been observed in subscription solutions and smart retail, with year-on-year decreases of -2.3% and -3.2%, respectively. The company has also experienced a decrease in amortization of an impairment provision for intangible assets, amounting to RMB 366.6 million. However, the AI product matrix has shown promising results, with a 66.7% increase in average monthly active merchants, a 77.8% increase in usage of core functions, and a 146.6% increase in merchants adopting WAI to set up stores during new customer delivery periods. The AI shopping guide has also achieved notable success, identifying over 400 customer sales leads per day for each merchant account and achieving a 30% year-on-year increase in sales during the Double 11 period. The company's multi-channel ecological collaboration has accelerated through deepened partnerships with Tencent and other strategic partners, building comprehensive operational service capabilities across multiple core business ecosystems. Overall, while revenue decline has been observed in certain areas, the company's focus on AI-related initiatives and multi-channel collaborations is driving growth and contributing to its overall financial performance. The net income of a company underwent significant changes between 2024 and 2025. Initially, in 2024, the company experienced a net loss, which decreased by RMB 1,502.5 million in 2025. This marked a turning point as the company's net income turned positive, with an adjusted net earnings of RMB 42 million in 2025. The profit margins also witnessed substantial improvements during this period. The gross profit margin increased from 44.3% in 2024 to 75.1% in 2025, indicating a significant improvement in the company's ability to generate revenue from its sales. Furthermore, the operating loss margin improved dramatically, reducing from approximately 100% to around 8%. This substantial reduction in losses is a testament to the company's efforts to streamline operations and improve efficiency. The increase in profit margins can be attributed to various factors, including cost-cutting measures, improved operational efficiency, and strategic decisions made by the management. The positive net income and significant improvement in profit margins are indicators of the company's progress towards financial stability and sustainability. The company's financial performance indicates a strong ability to generate cash from its core business activities. The data on page 28 shows an operating cash flow of RMB 1,234,019 for the year 2025, which is a positive indicator of the company's financial health. Furthermore, the net cash generated from operating activities and cash generated from operations are also reported as positive on page 32, with values of 5060 and 72,789 respectively. These figures demonstrate that the company is not only generating sufficient cash to cover its operational expenses, but also has a surplus available for other uses. Overall, these numerical evidence points to a consistent trend of positive operating cash flow, suggesting that the company is financially stable and capable of meeting its obligations. The company's debt level has undergone significant changes. Total borrowings have increased substantially from an unknown amount to RMB 2,064.5 million. Non-current liabilities show a mixed picture, with financial liabilities measured at amortized cost decreasing by RMB 228,462 and bank borrowings increasing by RMB 83,404. On the other hand, current liabilities reveal a decrease in trade and other payables by RMB 973 and a decrease in bank borrowings by RMB 241,654. In terms of interest expenses, there is a notable decrease in finance costs, which decreased by approximately 72% from RMB 173.7 million to RMB 75.3 million. However, interest expenses on borrowings have increased slightly from RMB 68,397 to RMB 69,864. Additionally, interest expenses on put option liability have also increased from RMB 5842 to RMB 612. In contrast, interest expenses on lease liabilities have decreased from RMB 2386 to RMB 1107. The performance of various segments and regions within the company has been mixed, with some areas showing significant growth while others experienced decline. Segments that performed well include Merchant Solutions, which saw a substantial increase of 65.6% from 2024 to 2025, as well as Tencent Channel and WeChat e-commerce ecosystem, KOL marketing in China, and brand agency distribution in China. Smart Retail also showed resilience despite a year-on-year decrease, with a quarter-on-quarter increase of 9.5% in the second half of the year. Additionally, Douyin, Zio Hongshu, Qxu, Alipay, and Huawei HarmonyOS expanded their market share. On the other hand, Weimob Marketing experienced a decline, with a 7.3% year-on-year decrease in gross billing. Subscription Solutions also underperformed, with a slight year-on-year decrease of 2.3%, accompanied by a drop in the number of paying merchants and revenue and gross profit decreases in 2025. Management is optimistic about the company's outlook, citing several key areas of growth and expansion. One notable trend is that gross profit has been growing faster than revenue, indicating an improvement in financial health. The company is also aggressively expanding into new channels, including popular Chinese social media platforms such as Douyin and Xiaohongshu, as well as Huawei's HarmonyOS. This strategic move aims to increase market reach and diversify revenue streams. In addition to channel expansion, management has emphasized the importance of integrating AI technology across all aspects of the business through its all-in AI strategy. This initiative is expected to drive innovation and efficiency within the company. Furthermore, the company is focused on consolidating its leading position in the Tencent channel while advancing a multi-platform strategy that leverages its strengths across various platforms. Internationalization efforts are also underway through Weimob Overseas and Heading Technology, which will enable the company to tap into new markets and customer bases. There is no significant activity to report on acquisitions and divestitures. The company has not made any notable purchases of other businesses or assets, nor have they sold off any major divisions or subsidiaries. This lack of movement suggests a stable and focused approach to business operations. The company's financial history reveals a notable trend. One significant aspect of its operations is the payment of dividends to shareholders. This indicates that the company has prioritized returning value to its investors through this means, rather than retaining profits within the organization. The decision to pay dividends suggests a commitment to shareholder satisfaction and a recognition of their investment in the company's success. That concludes the financial summary for Weimob Inc. Feel free to comment below, and I will be happy to answer them when possible.